Yes, it's time to get some business news now, and joining me is Evan Lucas, Chief Market Strategist at InvestSMART. Evan, good morning to you. Thanks very much for joining us. I want to start off with some new pieces of data today that private capital expenditure CapEx is talking about. How are you reading into that?
Yeah, look, Peter, the way you look at it and the reason it's so important is it's not something that we normally talk about in the media. And the reason for it is that it is, let's be honest, a little bit dull, but it is watched very, very heavily by the RBA, and it is a very good feed into what you expect around, GDP. So it is a survey of future intentions of spending by firms in Australia. And since basically the top of the mining boom, it has been in a fairly strong decline. What we saw last year is that we actually started to see a little bit more optimism and pick up. But what happened in the last two reads is that it's finally backing away again. And that is therefore feeding into, as I said, GDP. So that's private, what we call private expenditure. So, private investment and how that actually feeds into growth. But the other reason is the RBA looks at it from the point of view as an indicator towards the idea of employment hiring. It also goes into the idea of the underlying strength of the private sector and their growth expectations. So if you saw further weakness today, which is unfortunately what most economists are expecting, does bring the RBA into play. Currently, the market expects the RBA to cut rate one more time in 2019, most likely on Melbourne Cup Day. And if we did see a sign of further slowdown in CapEx today, it would really ramp that expectation up.
All right. What about the construction data? Help me out here, but it's the data is falling faster than originally thought. Is that right?
Correct. And again, this all feeds into basically the first question as well. So yesterday's construction data showed that despite the fact that you've seen a stabilisation in Sydney and Melbourne house prices, in fact, despite the fact that even with the AFR's big front page this morning, that you might even see a double-digit growth in housing over 2020 and 21 in housing, construction is going backwards. And that is a very good indicator, again, around employment. Construction is probably the first industry to see a pickup, and it's also the first industry to see the slowdown. It's when you do see a loss of hirings, it's when you do see a loss of investment, and that is clearly what the numbers have had. And that despite the fact that you've seen the June and July cuts go into the numbers as well. So it just all reiterates what we already sort of expected, what we've seen from leading indicators, why the RBA has been cutting rates, which is that overall the economy is slowing, and that therefore also unfortunately means that it's all around employment.
Well, why would construction be going backwards? And I suppose, does that dovetail into the need to kind of fast-track infrastructure projects going forward?
Yeah, absolutely. Very good point. And that's the argument that comes here and now. I mean, infrastructure is one of the easiest, fastest, most stimulating measures that you can do on a fiscal side. So getting public policy in behind it, backing it, and away you go. The person to really talk to you about this is actually John Hewson. He has an incredible ideas around how this could be done. At the moment, if you look at it from the point of view that if you were to offer an infrastructure bond backed by the Australian government's AAA credit rating and went to the Australian super funds and basically the big sovereign wealth funds offering them about 2%, which is what you get for a 30-year bond. In fact, it's less than that now. They would actually take that. You could fund these projects very, very quickly and get it into the economy very, very fast. And that is one of the core arguments at the moment. It's certainly been put to the government on a very regular basis. There is funding to be had. There is growth to be had. Because, again, if you look at it from a super fund point of view, the industry funds are doing that. You and I, as super fund holders, we're actually getting the return from that in our super. So there's a whole perpetual sort of uptick there that can happen from that point of view. And that's exactly the question that should be being put forward right now.
It's the Evan, the penultimate day of earnings season so far. How do you grade it at the moment?
Pass mark, and that's a really interesting question. So as you said, second to last day, we've had around about 172 of the 198 firms report so far. What we follow very closely, or at least the market does, is revenue growth and earnings growth. And if you look at the revenue growth, it's actually been better than expected. It's grown by about 6.5% across that whole group, but earnings growth has flatlined. And that therefore means that, unfortunately, things like expenses are still up. You're not seeing the kinds of returns on margin that you would expect, but it is nice to see that sales have held the line. So that's not what you would have expected. So it's a pass mark. Outlook from it as well has been a pass mark. They actually have been slightly more optimistic than I think what analysts would expect, which also just gives it a slight tick rather than a cross.